Welcome to the MUFG Global Markets Asia podcast. I'm Lloyd Chan, Senior Currency Analyst with the MUFG Global Markets Asia Research Team. The following podcast is for informational purposes only. It is intended for professional investors and eligible counterparties and not for retail clients. Any content should not be regarded as an offer to conduct investment businesses or investment recommendations. For this episode, we assess our outlook for the Indonesian rupiah following the 2nd April US Liberation Day and last week's Bank Indonesia policy meeting. The rupiah has found some support in a weaker US dollar and recent US-China trade de-escalation. Dollar rupiah fell to around the 16,300 level after trading near to the 17,000 level in April. Notably, the rupiah has outperformed the Bloomberg Asia Dollar Index since the Bank Indonesia policy meeting in April. When dollar rupiah was trading near to the 17,000 level, we have flagged that those levels are too pessimistic on the rupiah. Now, those market pessimism has been unwound. The rupiah could still face some headwinds going forward though, but we think sharp depreciation may be unlikely in our view, unless there is a very large US tariff shock. Indonesia's growth had slowed even before US Liberation Day. In Q1, growth slowed to 4.9% from 5% in Q4 2024. But Q1 growth partly benefited from a boost from high inventories and an unusually large agricultural output. If we strip out the contributions from inventories and agriculture, we find that the growth slowdown was much sharper. The boost from inventories and agriculture will likely be temporary though, so they won't provide much support for growth going forward. This means growth is likely to slow further amid trade headwinds. We look for GDP growth of just 4.6% this year, down from 5% in 2024. A key drag will likely come from a pullback in investment. Fixed investment had slowed to around 2% year-on-year in Q1 from 5% in Q4 2024. With investments in buildings and structures pulling back quite a bit. While investments in machinery equipment still grew, its contribution to fixed investment growth has notably lessened. Business confidence has also weakened in Indonesia. Manufacturing firms have been cautious following the series of US tariff hikes, with factory activity contracting in April. Bank credit growth has also slowed, notably working capital loans. It appears that Indonesian companies have been destocking and pulling back production in anticipation of weaker external demand. Investment loans have been growing strongly, but that has not translated into stronger investment growth. This suggests that companies are cautious given the uncertain global environment. There are also indications of some export front-loading ahead of tariffs, but it likely won't provide much support for growth due to Indonesia's small export exposure to the US. Exports to the US grew nearly 20% year-on-year in March, while the US share of Indonesia's exports rose to 11.3% in March from 9.9% in Q4 2024. Tariff front-running appears to be only limited to exports of chemical and textiles to the US. Based on the US tariffs implemented so far, 10% on Indonesia, we estimate the direct impact of tariff on Indonesia is likely to be small, as the country is not that reliant on trade. There will also be some negative spillover effects from the 30% US tariff on China. Indonesia has increased its reliance on Chinese demand. Today, about 24% of Indonesia's exports goes to China. This is the highest across the region and up from just 14% in 2017. About 20% of Indonesia's domestic value add in exports is also being absorbed by China. This means a slowdown in Chinese demand will also weigh on Indonesia's economy. With Indonesia's growth likely to slow further and inflation still well contained, we think Bank Indonesia will continue to cut rates in the second half of this year. BI has also been dovish in the May policy meeting, signaling that it wants to cut rates. BI has lowered its GDP growth outlook by 0.1 percentage points to 4.6% to 5.4% in 2025 compared to its growth projections from a month ago, despite the de-escalation of US-China tariffs. Our current forecast of 4.6% year-on-year growth for 2025 now sits at the lower bound of BI's latest growth projection range. BI has also cited the need to support economic growth and will continue to look for room to ease policy. At the same time, BI now sees the Fed cutting the policy rate twice in the second half of this year, once in September and the other rate cut to occur in December. We believe BI will be opportunistic in cutting rates. If we look at the March policy statement, it is clear that rate cuts will depend on the rupiah movement. The recent outperformance of the rupiah relative to other Asian currencies since the April policy meeting has given BI the perfect time to cut rates in May, which is in line with our expectations. We still look for one more 25 basis points of BI rate cut in the third quarter. We anticipate that the Fed could still cut rates, possibly twice or more in the second half, so that should give some space for BI to at least cut once, without unduly destabilizing the rupiah. Markets have also eased concerns about domestic fiscal risk, providing support for the rupiah. We don't expect markets to price in more domestic fiscal risk. Indonesia's budget balance has returned to surplus of 4.3 trillion rupiah in January to April, reversing the 104.2 trillion rupiah shortfall seen in the first quarter. This was mainly due to a 5% year-on-year cutback in government spending. The improved budget position could also support investor confidence towards Indonesia's government bonds. Finance Minister Sri Mulyani has repeatedly assured markets that Indonesia will maintain fiscal discipline, keeping fiscal deficits below the limit of 3% of GDP. Indonesia's trade surplus has also widened to $3.6 billion in Q1 from $3 billion in Q4 2024, providing additional buffer for the rupiah. Non-oil and gas trade surplus has been a key driver, while oil and gas trade deficits have been relatively stable. Exports rose 6.9% year-on-year in Q1, outpacing import growth of just 1.5% year-on-year. Nonetheless, Indonesia still faces the risk of full reciprocal tariffs, implying downside risk to growth and the rupiah outlook. Trump has announced a 32% full reciprocal tariff on Indonesia on US Liberation Day. This has been paused for 90 days until the 9th of July, but a 10% tariff is still implemented in the interim. For now, this brings implemented US tariff rate on Indonesia to about 14.5%. We remain cautiously optimistic that Indonesia could avoid the full 32% reciprocal tariff, although the current 10% baseline US tariff will likely stay. For now, Indonesia is negotiating with the US to avoid the 32% tariff rather than retaliating. We believe Indonesia's small trade surplus with the US should allow room for negotiation. Indonesia has also offered to buy more US agriculture and energy to offset its $19 billion of trade surplus with the US. Beyond trade talks, Indonesia has also accelerated its export diversification into ASEAN markets, with ASEAN's share in its exports up by 2.5 percentage points to 21.4% in March, from 18.9% in end 2023. We therefore believe sharp rupiah depreciation may be unlikely from here, unless there is a huge tariff shock or a significant re-escalation of US-China tariffs. Moreover, the US dollar has weakened. There is de-escalation of US-China tariff for now, and market sentiment towards Indonesia's bond and equity markets have also stabilized. In all, we expect lower BI policy rates and only modest rupiah weakness going forward. We look for a 25 basis points BI rate cut in Q3, possibly in September, and the dollar rupiah to stabilize in the 16,200 to 16,400 range in the second half of this year. Thank you for listening to the MUFG Global Markets Asia podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you subscribe to your podcast. Contact your MUFG sales representative for more information. Check back again for more insights from the Global Markets Research team.